Okay, there. It should show on all of your screens that we are now recording, and it is October 3rd, just after 2:30 p.m. Eastern time, 12:30 here in the at the on the western side of the Rockies. And this is the Market Structure Edge live demo and discussion. And thank you for being here. I'm Tim Quast, by the way. With me today is market strategist Brian Wilson, and he'll take the second half. Hopefully, it's a half. I've been gone, so I get to go first. And I've got four core things that I want to cover. And thank you for thank you for continuing to send me emails and say, what about this thing or what about that thing? Am I doing this right? How come this didn't work? Actually, I don't get a lot of those. There, a bunch of smart people using Edge. And I'm going to cover at point number three. I got this from a particular user. I don't know if you're here, Benham, but I thought you had good questions about. Oh, there you are. Okay. So I'm going to tackle because I think it's important, figuring out how to set your particularly your stops, because you can just die a death of 1,000 cuts if you don't have your stops figured out. So, and I'll tell you, this summer I went on a specific mission. So I had, and I don't want to jump ahead, but I do want to tell you where I'm going. I had Nate, I call him young Nate, the mathematician, because he's a lot younger than me. He's doing analysis all the time. I will give him parameters and say, check this, run the data on a large data set over these periods of time, and tell me what happens if you set your stops A, B, C, right? And we run it against the momentum and low volatility portfolios. And so then I went and tested all that stuff, and I was prepared to lose money, and I did for a period of time, but that's what I was going to do. So during the summer, I tested all of that, and I figured out, at least to my satisfaction, looking at the data, what's best. And so I teased that because I got two other things before I get to it, but I do want to address it, and I will. Thank you for asking, Ben. I appreciate that. Okay, so. Let me get to the platform, and I should be. Am I sharing? Yeah, I am. Okay. It hung for just a moment. Okay, point number one. I want to talk, since we're in this particular period. I say, when you look at how to use Edge, again, Edge is not. It's quantitative. It is not technical, and it's not fundamental. Although those are inputs. Everything is an input into demand and or supply, every conceivable form of strategy. And interestingly, Nate and I again are looking at a data set, and I'm looking at literally 200 firms that execute trades. There are thousands of brokers regulated by FINRA, but really only a handful of them are executing the trades. And we can look at that data because of the regulatory requirements. And you have to file what's called a 605 filing if you're as a broker dealer, you're going to have to meet best execution standards, even if you're a proprietary trader without customers. Then if you have customers, you have to report how you route them around what's called the national market system, comprised of a bunch of exchanges and broker-operated alternative trading systems. And I have a point out of this. It's fascinating to look at that data and see who does what, and how it's becoming more concentrated, and how fewer and fewer brokers are executing their own trades or matching or internalizing trades because they might not meet the requirements, and you get fined. If you don't meet the requirements. The point out of that is all of it feeds into supply and demand. It's why we have a lot of confidence in these data. There's no perfect data set. You could look at right here, for instance, right at the beginning part of September. We sort of expected this weakness at the beginning of September because demand was falling. So those who are new, we track how the market demand behaves between 4 and 6. The green line, the bottom line, if you can't see it, the red line, the top line. And demand is a 10-point scale, just an algorithm that normalizes order flow execution into a 10-point scale. And so with demand falling and supply rising, we expected a weak September. But how do you know that you can go long or short the broad market? I do that. I will do it at periodic points And you can use a variety of instruments. Let's just keep it simple and say it's the S&P 500. It's close to 90% of market cap. You could do a leveraged instrument. I oftentimes trade SPXL long and SPXU short. And but I don't, because I don't know from one day to the next. A day is not a trend. There are patterns and trends, but there will be lumpiness in all of those patterns and trends. This was a pattern and trend of a topping market, and we knew it because demand was over the red line. But there were ups and downs. So what if you shorted the market right here and then it shot up? Well, now you're in trouble, right? So what do you do? If you look at the data, you say, well, how come it didn't go down? Well, demand was still rising at that point. And again, it's a central tendency. They don't follow each other. Back to what I was going to say. Here, prices took off. This is the XPY or SPY as a proxy for the S&P 500. So demand was falling, supply was very high, and the market took off. And you go, what the heck? I mean, the data didn't do what we thought it was going to do. Well, remember, context. This was a bet on a rate cut. And a rate cut was going to be, whether you were quantitative or fundamental, likely helpful to equities. And so this is a manifestation of derivatives in the market. If overall demand is falling and yet prices rise, it is implied demand. You can just draw that conclusion sort of generally. And so, there's a departure from an expectation, but there's a ready explanation for it. It's why we say beware of those things. Market might not do what you want. But now we have a topped and falling demand, and we have falling supply. But here's the thing: how would you know whether to go long or short the market? And then, much more important, how would you do it? So on October 1st, so I actually said it on September 30. So on September 30, falling demand is still high. Falling supply, what do you do? Well, I bet short. Now, why? Because demand trumps supply. So that falling supply will mitigate how much the market might fall, and it could change at any moment. It's been falling for 15 days. That's a long stretch, just like it was 50% for 20 days. That's unusual. But I'm going to take number one, that demand is falling. That will likely trump the supply side. And then, because I don't know, I did a 2 to 3 bet. So I have 2 times, maybe I'll do it this way: 3 times SPXU, 2 times SPXL, because I don't know. Now I think I know what the probabilities are. I certainly know those, and I'm stacking the deck in my favor. I don't know if it's going to fall. Then remember the 1, 2, 3 rule. So the SPY moves on average, and we watch this 1% intraday. The basket comprising SPY, 500 stocks at any given moment, the S&P 500, 90% of market cap, moves 2% on average. Momentum stocks move 3% on average. I'm going to talk about that in stops and how to set your stops. YMM moves 5%. Right? So the volatility is a very important thing because it's created by machines. It is not random and accidental. It is Citadel et al. Calculating, being long and short large baskets of securities and trying to make sure they make money every single day by being long and short. They're the ones who are going to set the prices. All the rest of the stuff, plus their stuff, is going to determine supply and demand. So I have a pretty good idea what my risk is. What's the probability that the market moves? Well, if I use the broad measure, 50 basis points, that's half of it. Half of it, now there's a probability that Citadel might switch sides. It's not absolute, but if I'm using a derivation of SPY, like SPXU, 3 times levered, so a move of 50 basis points is 150 basis points in SPXU. It should be, not always the case. Then I know if either side of the trade moves 50 basis points and it's against me, I'm pulling it. So I did. So at 50 basis points negative on SPXL long, because the market was falling as I anticipated, I sold my SPXL. Modest loss. It's okay. I don't care. It's not what I'm after. I'm protecting myself. And then I made Oh, solid. Two better than 2% really on that trade. It was 3.5% on SPXU. My point is, what do I want the money I have exposed to the market to generate today? That's all I care about. Like today, I want to make 1%. I made 1% in 7 minutes and I'm done for the day. I went and rode bikes and I've got a lot of stuff to do. So that's the way I think about it. I don't think about whether a stock moved X amount or Y amount, or did I miss something, or do I have it priced right? No, I'm going to stack the probabilities, take the gain, and move on. Because if you do that you're trading as I try, I had about $45,000 in those trades. So I made, $530 on that. You say, well, that's not very much. In 7 minutes, I'll take that over and over. And if you do that every day, you will make thousands of dollars. And it doesn't work all the time, but it does. Statistically, it works very well. And I'm going to get to that in point number 3. But this is what you can do. And here we know that unless and until these conditions change, the bias is going to be to the downside. I don't know from moment to moment or even from day to day what's going to happen. Yesterday, I didn't set a short trade yesterday, but I thought hard about it. I just thought, man, I've got all this stuff to do in this block. I'm going to be out for this hour and a half, and I'm not sure, I can't watch it. But would I have shorted the market tape? Well, yeah, because that's the bias, right? If you can do it, you just want to make sure you protect yourself. If you short it, have a modest hedge. You can always pull that at a modest loss. And if you're right, it doesn't matter. It just protects you if the market moves against you. Brian and I were trading notes. Was that yesterday? I can't remember. I had to use it twice, but I still made my 1%. So I had a long short trade like that. And then the market recovered. So I had gotten rid of my hedge and I bought it and and then I sold it, picked up 50 basis points on the long side and then reverted more to the short side and made money. So they're not things you can do all the time. I don't do that all the time. I only do that on the short side very periodically. Here was an opportunity. Here was an opportunity. Unusually, we've had 3 in a row. Where there were opportunities to short the market. Doesn't always happen. You can have long periods where you'd say, I just can't do it. If the market never gives up any ground like this, terrible. If there's falling supply, demand just can't seem to, it doesn't really drop. It didn't go over the red line, not meaningfully. It did a little bit here and the market dipped. Supply jumped and you could say, well, I could short that and it would have worked out, but you really have to have some risk tolerance. But at these points, where you're way over the red line, those have been beautiful opportunities to go short the market. And that's how you can do it. You could do it with SQQQ, TQQQ. You can test that by looking at the big tech portfolio. Is it going to give you a return? Because that's what you're really shorting with the big tech portfolio. You're shorting the NASDAQ 100. You could go long and short mega caps. If I look at the broad market's topped and I'm figuring out which way I'm going to go long or short, and you look at big tech and you say, it's coming down. But, it has been a buoyant force for the market, believe it or not. It has, right? Supply has really dropped off. This looks a lot like the S&P 500, actually. So is that awesome? No, this would be a better short. But that's why if I'm picking, I thought, I'm not going to go SQQ, TQQQ. Hard to say that 3 times fast. But you could. And there are other things you can do. Like, Brian Wilson, I can't give you a strategy on this because I don't have one, but he's right about this. And it's something that I would call it speculative, but I did it. Brian trades UVXY. So you're trading volatility in effect. And so, UVXY is short volatility. And man, you can get 10% in like 2 minutes, right? But it's very risky. And I don't have a good gauge to tell you. I would certainly not do that when demand is rising and supply is falling. The only time to do that is when demand is deteriorating. When demand deteriorates for whatever reason, volatility only rises when stocks fall. Why doesn't it rise when stocks jump? Well, we can talk about that. And John Cook, you'd probably have an opinion on it. But we know in this maybe I tack that on, maybe just a little bit. I mean, if I'm trading, $10,000, $12,000 of UVXY as a I'm tacking it on to my short trade, and that thing moves 5%. I'm taking it, right? Or 10% as it did a couple of days ago. But realize it's risky. I can't tell you those are, what is the rock solid? How do you set a stop and limit on that? Very difficult. It is not predictable because there is nothing associated with it. It is wholly synthetic. There is no underlying asset class like there is with SPY that has an interest from investors with different purposes and time horizons. That's what matters. That's why I prefer that. Now, okay, so that's how to do that. That's really point number one. Now, number two, I've covered a little bit of this, is the horse and the cart. What do you do if broad sentiment is falling, but so is supply? And then you go look at your dashboard, like you go back to, I don't know, Thursday, Friday of last week. There were 60 components in these two portfolios. There are still 43 in momentum and low volatility. If you go to the daily trading ideas, which screens them further for probabilities, taking the same data set, but now adding an additional screen. And look, this is screened and screened and screened, right? We are finding the most liquid, least risky stuff that you can get in and out of with confidence, that it has lower spreads. In most cases, there are a few exceptions. And then we're screening them for probabilities. But you could look at this and go to the bottom and how many components are there in here? Well, there are 18 in that. And then if I look at low volatility, there are 21 in that. So what is the math on that? 18 and 21, 43, 39. Yeah, I'm in the math business. I should be able to do that. So that's a lot of choices. We say if there are 30 or more, that's a lot, right? So how would you know? Right? We just shove the stack of chips in on momentum trades. Well, no, because this is how you prioritize it. The number one force in the market is demand. The number two force is supply. The number three force in the market would be trading opportunities, momentum and low volatility. So you don't want to get them out of order. Look, I traded 2 of these today. I like to do this. You can sort for the lowest entry point because you get a lot of leverage, right? But it's also riskier. A low price means standard deviation rises. But I traded this. I've traded YMM and BEKE. And and this kind of gets us to where I'm leading in, Benham, to stops and limits. And I did put a couple of stops and limits on these. It turned out I wasn't in very long. But with YMM, so here's the volatility, 5%. It was down at, like right at the outset, maybe even pre-market, it was down 4%. So below the entry point. So I immediately checked the news. Is there some explanation for that? No. So it's just the fact that it's volatile, and it wasn't down all of its volatility, just most of it. So when the market, and I teed up limit orders before the market, but they were marketable, meaning they were within the spread because I want my trade filled. So call it like 943, right? So I bought a bunch, and then I have, there's this duplicate function on your phone. I don't have my phone right in front of me, with IBKR. And I'm just hitting bam, 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 99 share trades at the market. So I look like a machine. I look like a machine, and I bought, I don't know, like 2,500 shares of it. And then I stopped, right? Then the price came down. And so you could get worried. Well, I'm not worried. I know who's setting the price at the first hour of the market, roughly. High frequency traders are trying to figure out which way the market is likely to go and what the VWAP of the day is going to be. Because the VWAP, or whatever you want to use as your reference price, is the thing that BlackRock et al. Need in the last hour. You can know those things. It's not absolute, but a lot of stuff doesn't happen in the middle of the day. Machines are trying to figure that out, and they're setting prices. All the passive money needs the reference prices close to the closing prices you can get. So it's concentrated volume and order flow into the close. And if we know demand is deteriorating, which way is the market likely to go? Now it's held its ground, but point number 4 is, do we have a trend now in the end of new month and new money? Well, I would say we do. I would say October has manifested an absence of underlying 401k flows. The market has not had footing. It hasn't fallen off a cliff, but it sure hasn't had footing. So the point here is, so I know the probability is good that I'm going to make money, but Venom, where would I set my stop? Well, I'm 943, so I calculate 2.5% below that, bumped it up because of the amount that it's down, since it had gone 80% of the volatility, 2%. Now, do I want to lose 2%? No, but I don't want a machine to take me out when I know I'm on the right side of that trade. How do I know? Because of the supply demand balance. It is the opposite of the market. Now, it may not hold. If high frequency traders are the principal price setting force, their investment horizon is a day or less. So I'm unlikely to be in this stock with falling broad demand for more than a day. And so here's what I mean. Strong demand, falling supply. Price is down 4%, comes down a little more. Should I be worried? No. I set my stops and limits, and then the price started to recover, and I took them out. And I was trading notes with a colleague, and I looked, and I'm up a full percent in that position already. I mean, it moved hundreds of dollars in a matter of seconds, and I instantly exited the position because I don't care, right? I don't care if it continues up. I am after the return on my asset. Check. Same with BEKE. Let me go back there. I just did the same thing. It's 100% probability. Past performance is no guarantee of future outcomes. In the past, it has always worked out. It is, it's fairly volatile as well. I should have checked that. Let's go back there. So 10.3, and notice what it did. I could have stayed in it. 24.57 was the close. I bought it at around, bought it in the entry range at around 23.70. And I did the same thing. Bought a chunk, bam, 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 built my position. Price deteriorated. Should it get concerned? I mean, I was down 75 basis points on the position. I set my stop 2% below my entry point, 23.70. So when it got down to 23.40, was I a little concerned? Yeah, a little, but not much. And then it went to 25, right? So I sold it well before then. I just took my 2% and was gone. But will that work every time? No, there will always be some time. And statistically, it will be 1 out of 3, you could get stopped out. But 2 out of 3 with 2% or more way offsets the loss that you experience. So in 7 minutes, I was out of my positions today. I'm very happy with it. And then I could have shorted the market to boot so you can produce additional returns. I didn't have a chance. I'll look at it at the close. Okay, so I've chewed up a lot of time there, but I will stop there. And questions,
Tim,
comments, observations.
Quick question for you while you're on the daily trading ideas. When you're trading between your limits there, lows and highs, will you set those pre-market, or will you tend to let 15, 20 minutes go before you set up trades?
I build my position, then set the stops and limits. So in Interactive Brokers, I should have opened it. You can just go in, and there's an exit strategy. So I will use that exit strategy routinely, and I'll calculate, okay, I want to make, and if demand is moving in my direction in the broad market, I don't put a limit, because I might make 7% instead of 2%. Under these conditions, though, I'm very careful. I know that the market is going to have a propensity to slip, that these stocks could all of a sudden deteriorate. The traders call that a crumbling quote. If all of a sudden the machines say, no, we can't figure out where the price is, that stock will give back all of the gains. So you have to, under these current conditions, I'm very careful about that. If supply and demand in the broad market are diverging, I don't worry about it, and I'll put a pretty wide limit. The stop, again, why 2%? Well, it doesn't have to be 2%, but 2% is my risk tolerance. And if I've bought it down a third or more or half of the volatility, I'm not really worried. If the stock's rising right out of the gate and broad sentiment is rising, there are different things I will do based on what that stock is doing. And it always comes back to what my cost was and how much I'm going to risk. Well, if I know that the broad market, a big basket of stocks moves 2%, I'm willing to risk that, because all it is the risk of the market. It is beta, the movement of the market. And so I will risk that. And what you're trying to do is the probability. The difference is throw away technical signals because they're set by Citadel. I don't trust them. If you have them dialed in, more power to you, and I'm glad you do. I don't. I don't trust them because I know how the machines work. And they have better data and they have tremendous capacity to set prices. So I would much rather lengthen my time frame. And I think, Benham, you asked, well, what about if holding a position through a day? I mean, if I get to the end of the day, like YMM was a great example 2 days ago. I got rid of it because I made my money on the short side, shorting the market. And I was down, like 20 basis points in YMM. I think I bought it at about 9 and then I sold it at about, I don't remember. Maybe I bought it at 9.10 and I sold it at 9. That's what it was. So I bought it at 9.10 in the entry range, and by the close it was 9.01. And I just closed my position because I'd already made my return. But what was the mathematical probability that it would produce a return the next day? Very high. And son of a gun, what did it do? It went to 9.45 the next day, right? So that is a huge return. You can calculate that as it's a 5% return. I could have made 5% if I just had the patience to hold it through with my stop and limit. So generally, 1 to 5 days is a very good trading range because that's what we see in the patterns. Behind the scenes, all through the patterns, it's crazy. The repetition of 5-day patterns, 5-day patterns, 5-day patterns, but they deteriorate by the 5th day. Our ability to forecast prices deteriorates by day 6. All right, well, I'm not going beyond that. So that's my thinking. Is the probability very high that you could hold a position that didn't do what you'd hoped what it would do today to tomorrow or the next day and you produce a return? Mathematically, extremely high, but there's always an exception. Brian, I have chewed up. You were right. You said, what did you predicted how much time I would take? It was pretty accurate.
You're a smart man, Tim. I know you. I'm brief because I don't have the same level of intelligence.
That is not true. No, I have a lot of things on my mind to share with you. That's it. And I do believe these math because we've been looking at them for 20 years. Mm-hmm. That's the thing. This is not new to us. We have, for 16 of those years, it was about modeling outcomes for public companies. It's telling them what will happen when you report results. Why? What is the volatility you should expect? Will your price fall or rise? All of those things are very mathematically calculable because of the mechanics of the market. But it's a different endeavor to trade on that information. Our first experience was we didn't know that modeling for public companies did not immediately translate into modeling for investors. It took us what I call the aim small, miss small strategy. We had to really diligently apply ourselves to the math to reach the point where we are now. Now we understand what you have to do to make money using these data for trading purposes. So I'm confident in them. They're not always, there's no silver bullet, there's no perfect solution. But Benham, to me, the big takeaway is the math is more right than I am. I get, do I get a little uncomfortable at times? Well, of course. But if I trust the math, make sure I'm paying attention. What is broad demand doing? What is the supply side doing? What's on the calendar tomorrow or jobs data? Am I tempted to put in a long short trade? Yes, because I think the market's going to move. But the trouble is I don't know which way. Even though I could look at the math and say the clear mathematical probability is down, can I predict that will happen when Jay Powell speaks or the jobs data come out at 6:30, 8:30 a.m. Eastern time? No, I don't know. I don't know what bets people have made on that. So that you have to be aware of. And then the rest of the time, the math is going to take care of you. I will say 2% to 2.5%. If you have a lot of volatility, I don't want to risk more than the beta of the market. Hedge funds don't either. Millennium doesn't risk more than 1%, and they're pretty successful.
Hey, Tim, can we clarify one thing? One question came in from Corey. He said, I missed it if Tim enters his position pre-market or 10 to 15 minutes afterwards.
I like pre-market positions, but often better if demand is rising and supply is falling, because I know that they're likely to take off. So I want to get in them early. Machines are going to move the price. The machines know all the stuff we know. We know too. that the demand supply equation is favorable. And stocks that move at the open tend to continue moving, at least till that thing runs its cycle. And it runs a cycle at, it's 9:30 to about 11 Eastern time, maybe 11:30. And then things change. And
Yeah.
it's because of machines. So, but otherwise, like today, I had half of one position before the open, and then I added to it within between 9:30 Eastern time, just using that 9:30 and 9:34. I had filled all my positions. I was confident that these things, if they were going to move, they were going to move pretty rapidly because that's what the supply demand indication is in them both. But I also knew, so yeah, it's a mix. It's a mix.
Yeah.
I like to fool machines. I don't use round lots very often, by which I mean, do I buy 100 shares, 1,000 shares? No, I don't. I buy like 999, 1143. Why do I do that? Because then it looks like it's a mathematical allocation, right? How's a machine going to know? There's an order that comes in for 1143. Well, it's probably part of a large order, right? That's getting mathematically allocated and routed, directed. Most retail trades are non-directed, meaning your broker gets to determine where to send it. Well, all the machines know that. I mean, so I try to look different. If I'm buying 99 shares, the reason is at the market, the party with the best price has to fill my trade. It's the law. So I'm forcing somebody to do it. And if I hit the market with like 10 of those in the space of 15 seconds, it has an effect, right? It's that whoever's on the other side of that is going to go, wow, those are intensive orders. And then probably the price retreats a little bit and then it can move. I'm not saying I move the market. I'm saying the machines look at your order flow. It's going to come through in an algorithm. All that stuff is automated. The market is 100% electronic, all the same as 100% algorithmic. And how it comes through, if it's a bunch of round lots, they're going to, oh, it's a retail trader. Right? So, that's what's going to be known.
Benham, I'll pick up one of your questions about, wouldn't options be a better trading instrument? Sure, that works great if you have the time to unpack that. At the beginning, when we got daily trading ideas, I was doing that a lot with my trades, and I just discovered it was just more time consuming for me to try to figure out, which strike price do I get and some of those other variables. So for me, it's just easier. Like I said, for me, it might work out fine for you, but it's just I don't have the time to go through that, so I just buy the equity. But you can certainly do those trades on the option side. Yeah, there's nothing wrong with that whatsoever.
Agreed. I would echo that. The options tie to the underlying. Now, sometimes options, the tail wags the dog. It happens at options expirations, month ends, monthly options expirations. No question, it happens because there is so much options trading. One of the things we're looking at all the time. I probably looked at 150 of these in the last 3 days. I'm looking at 606 reports. They're a regulatory filing that brokers are required to furnish, and I look at what's happening. Like half of those don't even route their equity trades anymore because they've farmed it out. They can't meet the rules. But it's fascinating how many of them are routing options trades, and they're routing them all to prop traders. Like Susquehanna dominates that market. They're Wolverine, huge player. Well, it's high frequency trading. I would say options is a very, very crowded trade. To me, there's been so much growth in that market and so much concentration on it by retail brokerage firms because they make more money on those trades. It's a fact. I know that stuff inside and out. I know what they make on an equity trade versus an option trade. And they concentrate on all the education on options. Everybody's focused on options. I'd prefer to trade equities. There's less competition there and there's a really nice clear supply demand equation. I get your point though, that from a leverage standpoint, options are a beautiful instrument. I mean, you're basically getting 100 times leverage for nothing. And it's tantalizing, right? It is. I get it. It's like trading UVXY. Ooh, there's an adrenaline burst that comes with buying it down 3% and wham, it goes up 3%. But You know, I like the consistency of taking 1%, high probability, go home, do it the next day. There's no stress. You've got a lot of free time. I don't have to sit and look at screens. And I feel very well informed about what's going on in the market. Yep. Okay, I've chewed up our time. Brian, with apologies, maybe you and I just talk about what's next and we wrap up, huh?
Yeah, that sounds good. I can start with that if you want, Tim.
Yeah, please.
I mentioned this in the note this morning, kind of a possible comparison between April and October. And I'll show you what I'm looking at here. So I was trying to find instances of when demand or sentiment or demand was declining and short volume was declining at the same time. The closest that I found was moving back to the April timeframe. So what happened in April, sentiment was topping right about the beginning of the month. And as you can see, sentiment starts to decline. Short volume stops moving down and starts moving higher. Will something similar to that occur this time? I'm not sure, but if we look at this is a 5-day read. When we look at short volume, it's starting to incrementally pick up on a daily basis the last couple of days. I expect it will probably stop declining today, maybe tomorrow, something like that, if the data continues playing out, with what we're seeing right now. What ended up happening in April, and obviously this is an apples to oranges comparison, but you can see that sentiment declined all the way down to 3.3, 3.2 before we finally started to rise again. And you can see what happened with short volume. Like I said, I don't know if that will play out, but just extrapolating a little bit, which sometimes I can look a little foolish if I do that, but I could see something similar possibly playing out. Part of the reason why is we haven't seen we're still seeing pressure in big tech. So you look at what's happening in big tech, we're declining here through a monthly transition, exactly what occurred in the beginning of September. When did the market stabilize? Well, the market stabilized when big tech started to stabilize. We're not seeing that stabilization yet in terms of demand. And going back to the broad market one additional time, if we look at early August, that was 6% declines in 3 trading days. That was, I believe, 4% declines in 4 trading days. So we're certainly getting pressure at the beginning of the month. And so far, I believe we're down 92 basis points in 2 days and whatever, ends up happening today. So we're following a similar trajectory where we're not getting that new month, new money trade. Rather, allocations are either being reduced, to 401ks, or people are actually, needing money from them. I'm not sure which one it is, but either way, it's not great right now. So just wanted to show you what's happening there. Once again, maybe this scenario plays out like we saw in April. We would have a long way to go for that to, continue moving that way. This was 5% declines, by the way, when we looked at April trading. So that's kind of what I'm seeing in the data. It probably a continuation of these declines until big tech starts to stabilize.
I can't add to that. That's excellent. I think that's a good stopping point. We'll cede you the rest. Well, actually, we've consumed all of our time, so I consumed all of our time. Great to see everybody. We'll do it again next week, and I will be here.